But nonetheless, good morning to everyone who has dialed in from different parts of the world for this very, very exciting 2 days on India Infrastructure Finance in India conference. Today we are on the first session of the day, and when we talk about infrastructure finance, the session has to begin with the lenders. Lenders play the most significant role in infrastructure finance in India. As per RBI data, 1,92,381 crores are deployed in credit to infrastructure sector as on June 2021. However, in FY 2021, the banking sector credit contracted by 6% to India infrastructure segment. The RBI has attributed this to the bad debt overhang in India's infrastructure segment. This, according to the RBI governor, has made India's lenders risk averse and quite limited in what kind of exposure they would want to take on their books. It is in this background the RBI governor asked India Inc. to look beyond banks to fund infrastructure projects. Correspondingly, in the budget of FY22, the finance minister announced that the government will set up rupees 20,000 crore development finance institution with a view to mobilize rupees 111 lakh crores required for funding the ambitious national infrastructure pipeline. The government proposes rupees 20,000 crores to capitalize this institution and aims to have a lending portfolio of at least 5 lakh crores in 3 years. The debt financing of InvITs and REITs was also made easier by allowing FPIs to provide debt financing. While the stress debt in India infrastructure segment has grown to an alarming 27 billion over time, RBI's annual report for FY 2021 noted that the sectors such as highway infrastructure has shown rare resilience to even the pandemic. Such resilience of the Indian infrastructure sector, despite the monumentous events such as COVID-19 pandemic, could be one reason why, even though shares of banks in infrastructure lending contracted in FY 2021, NBFC lending to the infrastructure sector increased in 2021. Even the World Bank has committed around 30 billion for the period 2019 to 2022 to the Indian infrastructure sector. Its lending covers almost all sectors like railways, power, aviation, iron, steel, coal, mining, telecommunications, you name it, and they fund it. Asian Infrastructure Investment Bank has also invested in 21 projects in India, amounting to almost 5.5 billion. It plans to invest in another 20-30 projects amounting to another 5 billion in the next 2 years. Today, in this background, we are joined by eminent bankers at the panel to discuss lenders' viewpoint on the current challenges being faced by the lenders in India. We have representatives from the 3 largest banks in the country. Harshal Mahawarkar, Vice President Project Finance and Structuring, SBI. Prashant Murkute, Senior Vice President and Group Head, Axis Bank. And Ritesh Sampath, Executive Vice President and Head, Debt Capital Markets and Project Finance Investments, HDFC Bank. But we don't want to stop at the challenges. We are here to provide solutions and the next steps. And when the problem is so grave, the solution ought to be disruptive. Today, we are also joined by Arvind, Investment Manager, Omi Bridgeway, a specialized fund on litigation finance and management. He will discuss how partnering with lenders can benefit with partnering with litigation funders, the lenders can benefit to increase recovery of NPA accounts without further stressing their balance sheets, and how a new approach of overseas recovery needs to be followed to increase recovery from lenders. With this, I would like to jump in and pose questions first to the lenders and then to Arvind. Prashant, Good morning.
Morning,
I will,
Pratik.
how are you? I want to start with you today. And of
Yeah.
course, Axis Bank is one of the biggest players in the Indian infrastructure sector and one of the
Yes.
largest banks which people look at. What's their stance today towards the current infrastructure scenario?
Uh, yeah. Thanks for asking me this question. I think we have seen a lot of history in past, uh, the ups and downs in the infrastructure industries, the mistakes which everyone as a lender has made in this industry, and there has been a good learning for the lenders in this industry. The clearly the stance now for the lenders comes from the aspect that uh, post all these BOTs and BOTs debacle and all that, the lenders have started concentrating more on hybrid annuity projects, which are which provides a kind of an annuity flow to the lenders, which lenders usually like. Hence, the growth has been more in that region. We have been taking measured risks in infrastructure space. Uh, and mainly fueled by the hybrid annuity. That doesn't mean that we haven't been taking uh, toll risk or pay as you go risk. We have been doing toll projects also. We have supported some of the InvITs also. However, we are a little cautious, and the kind of aspects we do see over there is what is the base traffic today as we speak, and what is the multiple of the debt which is getting financed as a multiple to the base traffic. Uh, and in terms of taking construction risk, there also we are taking measured risks. Measured risk in the sense that we normally like the developers to take an equity commitment for their new projects to the extent of 1 to 1.5 of its net worth. We would be happy to see equity commitments in the region of 2.5 or 2.25 times of their present EBITDA. If it's something below this kind of a multiple, the lenders, I believe, should be comfortable with the financing of the under construction projects also in a limited way, especially in road projects. If you see from a bigger backdrop, the increase which is happening in the lending space in FY21 has been 3.6%, and it is mainly fueled by roads and ports to some extent. Uh, Ports also continue to be a good source of lending for the lending community. The margins have been in the region of 68 to 70%, if I'm not wrong, and non-major airports are also started seeing increased traffic. All in all, yes, we are supporting this industry. However, taking measured calls over here.
Those are very interesting points, Prashad, and I think if I summarize, the focus is towards caution. We are looking to move away from the old mistakes like open projects, toll and pay, BOTs, and moving to hybrid annuity model projects. And it's very interesting you mentioned hybrid annuity because this model was pretty successful in different parts across the globe, and now it's coming in big force in India. And the focus on HAB, if I may ask a follow up question, is it also with the perspective in mind that today there are going to be REITs and InvITs available for banks to at some stage get an early exit? Is that something which plays in the bank's mind?
If you see from a banking space, uh, the in a good days, actually all the infra assets, though they are long-term assets, they get refinanced refinanced in a space of 3 to 6 years space. And now that the markets are opening up, uh, with InvITs and more of IDFs and more of internationally green bonds, which where people are having solar assets which are going on. So I think this is a good space to churn the portfolios with these new lenders.
And that's important, right? The churn of capital is something we face problems with in infrastructure, and it looks today with the new kind of tendering and the new kind of approach being taken by the government, that churn which was long missing would come back in the sector. Moving forward to Harshal from SBI. Harshal, of course, SBI and infrastructure are synonymous in India, and one of the largest lenders in the country for infrastructure sector. What's SBI's stance today on in the infrastructure sector?
Yeah, hi Pratik. Good morning to you and all the participants on this event. Well, taking cue from Prashant, what he was mentioning a while back of banks being a bit cautious on infra space because of whatever experience they have had in last decade in that particular space. But to look at the positive sides, what I see, uh, the stance is getting slowly being shifted from being cautious to being optimistic. And this optimism is stemming probably from the changing macros. And when I mean changing macros, now there are a lot of things are happening in the infra space. Banks have learned their lessons, of course, but the conducive environment which is being created around infra space is probably giving the confidence to the banks to being more optimistic. So when I say macroeconomic indicators, from macro perspective, say for India to achieve say $5 trillion economy status, which is a stated dream of this country, investment in infra is probably non-negotiable, and our infra spend is still languishing below 6%, close to around 5.5, 5.75% of GDP. When ideally it should be somewhere close to 7 to 8% if you have to learn from the developed economies. Now, if you look from this particular backdrop, the COVID had temporary blip on infra space, but I would rather see is more heartening the way the sector has responded to this COVID blip. The recovery has been quite smart, almost V-shaped to say the least. For example, if you see the toll collection are almost back to the normal. Project awards in road and renewable sectors are also increasing. So in fact, road construction is happening at a record pace of around 35 kilometers a day. Another macro environment is a government taking initiative to smoothen the roadblocks faced by the sector, like awarding part COD in the HAM projects, changing model concession agreement, relaxing bidding criteria to foster competition, or for that matter, FASTag implementation. And above all, NIP has given a direction and vision to mega investment in this particular sector. And quite a large part of overall NIP funding is supposed to come from the center and state. And the recent announcement of monetization pipeline also bodes well for the sector, as it provides clarity around the capital resources which would be required to implement the NIP. And introduction of DFI, innovative financing structure we just mentioned, like InvITs, TOTS, they also hold promise for the development of infra in this country. So overall macro environment is looking quite conducive for infra development in this country. Now, apart from macro, I just also wanted to, touch upon a fact which we are seeing in terms of availability of private capital or the promoter equity for the underlying infra project. So we have been seeing this tectonic shift which is happening for the underlying infra asset, where classical promoter equity is now being replaced by private equity or the funds in the infra space. So this also gives us comfort to the lenders from governance perspective. Banks and NBFCs have always been cautious on this particular space because of their prior experiences, ALM mismatches. But the risk aversion has to come down so that the lenders become more optimistic when the current economic scenario provides a great opportunity for the banks. So we at a bank have been seeing healthy pipeline across the infra sector, with roads and renewable leading the race. Other subsectors like airport, oil and gas, CGD, fertilizers are also providing decent opportunities. And what's more heartening to see is the core sectors like steel and cement are also coming up. So which shows the way where economy is headed. So from that perspective, to sum it up, I would rather say the banks are being cautious, they are now being turning more optimistic with the changing economic environment.
Those are very, very good points, Harshal, and I take two takeaways from your speech today. One is the government initiative, and second is the governance. And I think we will hear more about this in the session with the private equity investors, but they resonate with you. I think the lenders are not the only one who face the governance issues in the infrastructure sector. It's the all-around circuit and including private equities. And you rightly identify that private equities today are moving to the control model. And once, originally we had them below the 50% mark and on right segment also below that level. But today they are moving more to the controlled management of infrastructure asset where they are taking in higher equity and they are managing the show themselves, getting professional management.
So many, whatever has to be done has been done. It is the capital which the banks and the promoters have to now provide to kickstart the economy. That's where I will leave it at.
Well, thank you so much, Harshal, and those are very useful words. Ritesh, you heard Prashant and Harshal before you, and they resonate a tone here of positivism. They say, look, what happened in the past happened in the past, but today we are seeing good model tendering, we are seeing increased governance, and we are seeing better government initiatives. And the outlook seems to be positive in a sense, but of course there is some remorse of the bad experiences in the past. What is HDFC's experience? What is your experience in this field?
I couldn't agree more with them. I think most of it, has been said. Yes, there were issues earlier. HDFC Bank historically had kind of, stayed away from long-term financing. We are obviously, evaluating, various projects. We have done, transaction across road and renewable sectors. I think there are, three key pillars of when we look at infrastructure financing. First is, the financial independence or viability of the project. Second is, availability of land, ROW, necessary clearances, etc. And the last one being, equity visibility and execution capability of developers. So, yes, at macro level, there is possibility. I think, government has taken into account various, suggestions, given and incorporated in the concession agreements. But even let's say HAM, which has been, the most successful recently, there are players who are able to get financing easily, whereas, there are other players who had to actually surrender their projects and they were not able to complete their financial closure. So I think, these three parameters are, very important, when any bank looks at it. So if all the loose ends are closed, I think, banks are, more than happy to, provide financing. But if there are loose ends, then, banks become, more cautious, about financing those projects. So that is a clear, trend which is, kind of, coming out, that we see. So for good projects, there is enough level of competition. I mean, I'm sure, Prashant and Harshal can also validate that. I mean, there is no dearth of capital where, the project is rightly structured or where there is, a reasonable equity visibility which is available. Also, if we see, for completed projects, as you rightly said, they're moving to InvITs, which has the inherent benefit in terms of, one is the pooled mechanism as compared to a standalone, infrastructure project, which has, only single cash flow source, and also the, better debt equity. So, I mean, that's again something which is a positive development from the lender side as well as from the developer side. Lender side because because of this pooling mechanism, right sizing of debt, and refinancing of debt to align with the cash flows of the project. We have seen that most of these projects are highly rated once they move to funds or InvITs. And for the developer, it is better because it releases his equity, which can be redeployed for new projects. So that's that is definitely giving a lot of confidence to the lenders there.
So would you say, Harshal, that there is a overall improvement in the credit deployed between 2021 and 1920. Do you see the credit deployment improving overall?
I would say if you see, yes, there is a credit deployment and infrastructure improving. If you see in HAM alone, there are like 240 projects which have been awarded by NHAI over the last couple of years, and most of them have been able to achieve financial closures. Similarly, in renewable space as well, renewable transmission, CGD. I mean, there has been a reasonable amount of awarding which has happened, and banks have lent even for asset monetization program, because these are completed projects and revenue visibility is higher. There has been reasonable amount of funding happened for those projects as well. So on and all, I would say ki, yes, there is a positive stance towards some of these completed projects which are coming in.
Thanks, Ritesh, for that. And moving with the same question to both Prashant first and Harshal later, do you see the credit deployment getting better and improving, and will that come from the lenders again, or do you think the 6% drop is something which is worrying and it's going to continue in the near term? Prashant?
There is some echo happening of my at my end. I don't know if it's pertaining to only a tech problem at my end or generally everyone is facing. But nonetheless, just to answer what I understood from your question is, what is the way forward, and how do we feel that the credit growth in this particular space is going to increase? To my mind, yes, with the right kind of an ingredients, the lending in this space is likely to increase. Uh, yes, as we see that the asset monetization of most of the players working out and getting flipped into private equities, getting flipped into InvITs, bankers or lenders become more enthused that if they finance the right projects with right ingredients, uh, they would expect that these such assets would get eventually flipped up into these kind of platforms, thereby the, the liquidity in the infrastructure developers likely to increase, and hence the health of the developers and the players in this industry is likely to improve, and this would fuel the credit growth in this sector. This is what I feel.
And Harshal, do you agree to this?
Yeah, absolutely. If you see, the question that you asked about was, the change in terms of credit deployment over last year. So the probably the short answer is the credit deployment has been largely flat or marginally improved in 2021 versus FY20. You also mentioned about 6% drop in credit deployment in infra space in 2021. But in the backdrop of this kind of black swan event of pandemic, 6% drop, I will take it as a positive rather than any setback to this particular industry. So most of the pandemic span was, of course, affected by construction pace going down quite significantly for under construction asset, and operating asset also taking hit on the revenue streams of the operating project. So despite that, if the credit deployment has been dropped to only 6%, that's a positive sign I would like to see. Another point really which we need to touch up on is the sector for long has been facing the issue of twin balance sheet problems, where stressed balance sheets are there on either side of lender as well as the borrower. But the environment seems to have improved starting Q3, Q4, FY21. So I hope with all the cleanup that banks have done, particularly in infra space, uh, and I just hope that the worst is behind us. So probably, the credit deployment from bank perspective will be also back on track with cleaned up balance sheet. So, so, but overall, what I would take it out is, rather than seeing just 1 year trend, it is important to see a longer period trend in these kind of sector because all your underlying projects are 15, 20 years. So rather than seeing 1, 2 year trend, it has to be seen decadal trend, what's happening in this particular space. While the trend is positive till date, I expect the current financial year to be much better, and with slew of factors which we just discussed, like enabling growth. Uh, so, I expect, this particular year to be far better, and next few years to be, good for this particular industry.
No, that's a very positive view on this, and just to take you further on a thought you left, you said both sides of the balance sheets are stressed, and that requires a different outlook on how you approach this financing. We did hear that you're looking at a different crop, you're looking at different models and governance models, and the teams who execute it, but that may not really help addressing the issue which you raise of the stress balance sheets on both sides of the company and the lender. Now, how do you structure the deal to avoid this high level of stress and default? What is your experience in the new ways banks are approaching these past hangovers?
So, as we were discussing some time back, lenders have burned their fingers in this particular space. So they have, of course, learned their lessons. So the structuring we see these days is far, superior in terms of execution. Of course, infrastructure financing is typically SPV-based, ring-fence project cash flow structure with underlying concession agreement. So we have to consider the underlying cash flow for this kind of funding in terms of predictability, one, and the strength of counterparties to those underlying contracts. And what we also need to consider is various provisions and watertightness of such agreement. What is happening in this particular space is, one of the key hindrance to this particular investment in infra has been the visibility of equity. So the banks have also now started, demanding higher upfront equity so that there is a clear-cut picture is presented before the banks. We evaluate visibility of equity and demand higher upfront equity. There are, if you see certain balance sheets are stretched in terms of borrowing capability, but few of the healthy balance sheets have actually deleveraged recently in the pandemic by way of equity infusions. So you need to choose and pick the right infra assets where equity is visible, equity can be committed. So that provides good entry point for taking the leverage up where, there is already a deleveraged balance sheet on account of equity infusion. Innovate, we spoke about TOTs, we spoke about these kind of models, of course, were not present earlier, but they give much more better cash flow comfort to the lenders, and that's where we seek comfort also. Another aspect which I would like to touch upon is tighter monitoring of the project. So banks have also started, appointing this asset monitoring agencies to closely monitor the on-ground development for infra projects. So these agencies have become eyes and ears of the bank, and we are getting, good feedback in terms of ground level situation as far as monitoring is considered from them. As Ritesh was mentioning some time back, right debt sizing is probably the most important factor when infrastructure projects are to be, considered. Rather than being aggressive, the lenders have become, cognizant of the fact that the debt size has to be right for infrastructure projects per se. And so coming back to the, the questions whether there would be defaults in this industry, any industry for that matter will have default, and infra would of course have heightened risk of default. But yes, at the end of the day, you have to identify the risk, map the risk, and mitigate it. So how do you, identify it, map it, and mitigate it is the real question.
Right. So that's very useful, Ashar, and I'm going to put the next question to Ritesh. This is focused on the COVID-19 pandemic. How has this affected the availability of equity and debt for infra projects? You heard just now that there is a view that banks are looking at more equity to be able to get more comfortable. Is there that availability of equity and debt in the market for other lenders to take comfort from?
So I would say, for the right sponsor, there is no issue with availability of debt or equity capital. Uh, I mean, if you see, in addition to bank loans, we have seen appetite even in the bond markets, debt capital markets for whether it be, completed hybrid annuity projects, or whether it be InvITs, or whether it be renewable projects. And, this capital is available at a, reasonably competitive rate. So, banks are definitely competing with, other sources of capital in today's time. If you see larger companies like, let's say, Adani, Summit Digital, Bharti, I mean, they've been able to access the dollar bond markets as well, the international debt capital markets. Uh, we have also seen, successful IPO be completed by GR Infra recently. Renew Power became the first Indian company to list on NASDAQ. So, there is, enough and more, examples available of, debt and equity capital being available. But yes, it has to be, the right sponsor, the reputation and the, balance sheet of, sponsor is, paramount as far as this is concerned. The asset monetization program has been slightly delayed, because of the COVID. The NHI Invate and some of the TOT projects had to be delayed because there was some variability in traffic on account of lockdowns. But even the traffic has shown quite a bit of resilience there. So sectors, if you see, airports have been, significantly impacted, right? So availability of capital in that sector is, to some extent impacted. So, roads, renewables probably less affected, airports, more affected. So, depending on the sector, availability of capital really has not been that much of a challenge. In fact, even for under construction renewable projects recently, there was a dollar bond issuance which was quite successful. So, and one of the reasons which I would say is, one of the reasons for drop in bank credit that we have seen is also because of availability of alternate capital means, including the dollar bond markets, including the equity markets, or even InvIT. So when the, the asset goes to InvIT, because of the 1:1 debt equity, requirement, the overall, debt comes down. So to that extent, the credit profile increases, but it does have impact on the bank credit overall, on an overall basis.
Right. Uh, I'm going to move to the last question in this segment and then move to the next segment. And this is to Prashant. Prashant, what would lenders expect more from policymakers to review credit growth? What are the expectations?
So, yeah, from our experience, I think the policymakers, especially from the guys who are awarding such projects, they should demonstrate that they are behind this project, they are behind this sector by giving timely decisions on what are the problem areas in this sector. For example, termination payment for on some of the older assets. They keep on dragging on for many years. There should be a timely payment mechanism. They should agree on the points which they have signed up, or concessions which they are signing up. The clauses normally get tested out in the court. There should be a process of a faster arbitration or resolution wherein they need not follow the entire rigmarole of going up to the Supreme Court to have something resolved. Then there is another aspect of faster resolution at NCLT cases also, where if people see that there is faster resolution uh, at NCLT process, that is something which will excite the lenders. For example, also in case of state projects also, if they want support from the lenders, they should have timely injection of their capital into their balance sheets. And I think one process from a center point of view, which brought good exuberance in this sector was Atmanirbhar package, which was available for many of the infrastructure players, which actually reduced the working capital cycle. So this is a kind of a proactive steps which the policymakers, the government should take to actually help fueling the locked working capital cycle in the entire sector. This is my view.
Thank you so much, Prashant, and this gives me a good segue to the next session. And I say this because you raised two very important points. One being the arbitrations have to be arbitrations. In India, the arbitration ends at the Supreme Court, which is slightly unbelievable from the international perspective because arbitration doesn't go into appeal. That's the point of finality. And also the point you make on NCLT that the experience is good, but maybe it's not at the international level. It still takes time. The NCLT, the judicial members sitting at the NCLT may not be savvy enough to deal with the problems they are being faced with. And those are leading to delays in adjudication that has increased dispute, or at least the dispute area hasn't gone better, which of course is leading to a lot of collection issues. And there is a saying which they say that the biggest beneficiary of the lack of Indian judicial system is the government at the end of the day, and the PSUs, because they are the biggest defaulters in a way. If they lose the arbitrations, a lot of debt today is collectible, which is effectively going to go back to the lenders and being pumped in the economy. So the problem lies in recovery, and the person you're recovering from is often the sovereign or a state-owned entity. Now, historically, banks approached recovery in a localized fashion. However, the need of the hour for infrastructure companies and government entities is to focus overseas. The growth of infrastructure sector has exposed these companies to the overseas market. They are now open to new doors of changes to focus on recovery on overseas assets. And I say this because the session before we heard the new structures coming in. There is a lot of reliance on InvITs, a lot of reliance on REITs, reliance on foreign bond markets. This has created a lot of footprint of overseas recovery on these infrastructure companies. I think the innovation lies in internationalizing recovery by understanding the status of the debtor's debt and potential areas of avenue. We saw a very recent example of how Kane and Vodafone have used international recovery mechanisms to lead to a conclusion finally on recovery. But Indian banks often find it difficult to execute such recovery strategies. I think one big reason is lack of branch offices in overseas locations, or all overseas locations where they would want to execute the strategy, or plainly lack of experience which allows them to think out of the box in this case. There is also significant cost associated with running such cross-border investigation and recovery strategies. Banks avoid such further strain on its balance sheet and manpower, and it's fair, right? Nobody likes throwing good money after bad money. I think in this situation, litigation management and finance can prove a game changer for banks. The focus has been in the past at restructuring. I personally think the focus has to shift to recovery, and that recovery has to be international. Today, no one has a magic wand to change India from 136 rank in contract enforcement to rank 1. But with access to international enforcement mechanisms, I think bank can leverage the advantage of jurisdictions like Singapore, jurisdictions like UAE, DIFC, jurisdictions like UK, France, where there are footprints, or even US, where there are footprints of assets which are left by companies you have financed and have recoveries due towards. And to discuss this today, I have Arvind from Omni Bridgeway. Arvind is lawyer by training in Singapore, but an investment manager. And interestingly, the asset class which he looks at is disputed assets and recovery. Arvind, how can banks increase recovery of NPA without further stressing their balance sheets, partnering with Omni Bridgeway?
Thanks, Prateek, for that kind introduction, and thank you to my fellow panelists for a very enlightening discussion on the state of play of the infrastructure sector and financing in India. Before I answer the question, Prateek, I thought maybe a brief introduction about who Omni Bridgeway is might be helpful for the attendees. We're the largest litigation funder in the world with over 150 specialists such as myself, deployed across Asia Pacific, EMEA, and North America with funds under management of about USD $1.5 million. The nature of our business is to provide financing on a non-recourse basis, as well as strategic know-how and management skills from case inception through to post-judgment enforcement and recovery, a business in which we're truly global leaders. To answer your question now, based on our experience working with lenders to recover their NPA or NPLs, we can provide two solutions really. The first is monetization of these NPLs either by a wholesale or partial purchase by us, typically at cents to the dollar. This makes Omni Bridgeway the legal owner of the NPL portfolio, and OB then acts as the resolution or enforcement service provider by financing and managing the legal recovery of the NPL portfolio. And there are two distinct advantages for lenders or banks who use this solution. First is it allows the lender to remove such NPLs from its balance sheet. And second, there are no fixed or retainer fees charged by Omni Bridgeway for its service, so that all amounts recovered less Omni Bridgeway's success fee will be for the benefit of the lender. The second solution is the one that you alluded to just in your introduction before this part of our presentation, is the funding and management of disputes, be they arbitration or litigation proceedings, as well as the enforcement of unpaid awards or judgments against the debtors directly. Now here we leverage on our unique global enforcement and asset tracing services to optimize recovery. So depending on the situation, we are open to providing tailored solutions such as a hybrid model of what I've just mentioned to meet client requirements and the relevant regulatory frameworks.
Thanks, Arvind. That's very useful background. And I know that Omni Bridgeway has also partnered with the International Monetary Fund, and you all run a very interesting distressed asset recovery program focused on helping lenders exclusively to recover their NPAs. Could you, and I know Marine who's the head of the MENA, Dar, will be with us shortly in a session to follow. But as a background, could you tell the lenders and the audience of your experience on working with banks internationally, and how have banks used this? You know, if you can name a few banks, maybe not who you've worked with, but who has successfully used this strategy to recover assets.
Yeah, sure. What I'll do, Prateek, is that I'll leave Marine to speak about the MENA DARC project or joint venture that we have to assist banks that have operations or exposures overseas, including in the Middle East, North Africa, and Eastern Europe, and so on. But let me perhaps try to specifically answer your question about how banks can use litigation finance in terms of enhancing their recovery. As you mentioned earlier, where a debtor has assets overseas, banks may struggle to recover basically because of a lack of experience, particularly where their business has historically been lending to domestic players with assets onshore in India. And I think that's where Omni Bridgeway brings our unparalleled experience of over 35 years to the fore by creating multifaceted strategies across jurisdictions. So by way of illustration, we would identify the asset of a debtor in offshore jurisdictions, decide which jurisdiction is more favorable for the enforcement or recognition of an award, because as you can appreciate, certain jurisdictions are more arbitration friendly and certain jurisdictions less so. And then we devise asset seizure strategies appropriately by sequencing which jurisdiction to go first and what the appropriate legal strategy should be in the particular case. Now, sometimes, particularly recalcitrant debtors will do their utmost to defeat or deprive a creditor, such as the lenders, of their rightful recovery. So one thing to start thinking about is creative solutions. We, for example, gone as far as to do interesting things such as seizing the property, apartment specifically belonging to the mistress of the debtor. And that brings a sort of different dynamic or leverage to the table. Or in situations involving sovereigns or quasi-sovereigns, we leverage on negotiation or diplomacy with context which we've built over the years. So that those are sort of at a fairly high level, some of the strategies that we can employ. I'm afraid that going into a degree of granularity is going to be a bit difficult for me because a lot of what we do inherently trade secrets and things which we jealously guard. But we found that with partnering with us, we've been able to successfully help clients both in the finance sector and outside of the finance sector to recover on debts which historically they had real difficulties with. And we've done so in exotic jurisdictions like West Africa, I'm in Kazakhstan, I believe, and I'm personally managing a portfolio which comprises an enforcement now against Southeast Asian state, and that requires quite a bit of work and looking at different ways of trying to attach different assets overseas. So it can be anything from bank accounts that you can find overseas which are being used for commercial purposes to hard assets, whether they are power plants or whether they are aircraft. It really depends on the particular debtor, but those are some of the types of assets that we look at when we try and effect a seizure strategy.
Thanks, Arvind, and that's very useful. And if I'm right, what you're suggesting on sovereign recovery would be something very similar to what we've seen recently in the media against the Indian government, done by companies like Kane. And I think a lot of us have taken note of how internationalizing this recovery can change the negotiation bargain with government entities and government. But I'm going to still try to get an answer from you, which is on who are these players who have been successful. And I'll at least say the names in public which are available. We know that Citibank used litigation finance very successfully after the global economic meltdown, and it spun out into its own entity, which is now running very successfully in the United States. And that was a very uniquely successful example of litigation finance. I know this is confidential, but if there are other names in the public domain which you could share of other banks which you know who have used this strategy successfully.
Yeah, in terms of the portfolio that I'm managing, I can't think of banks offhand that have used our litigation funding in order to pursue a recovery. But we have encountered private financial institutions or large corporate clients who have used our financing in order to achieve those sort of recoveries. We're looking at a company in Singapore with a multi-million-dollar arbitration claim where we've supported funding for them to pursue an arbitration. And that's quite interesting because I think earlier you had mentioned something about restructuring and how perhaps people may want to start thinking about moving away from restructuring and looking at international recovery. And I think that's to be applauded. But I thought to pick up on that point and share with you this example arising in the Singapore context, and perhaps you can tell us or about whether this also applies in the Indian context. This arises out of a restructuring type scenario where a Singapore company I just mentioned was in a scheme of arrangement, and we had provided funding in order to pursue an arbitration against a Korean financial institution arising out of breach of receivables purchases agreements. So these are trade finance style arrangements. And we got a super priority order from the Singapore High Court to protect our investment and returns in relation to the funding of that arbitration. So what that means is that we would have security and preference over any potential recoveries from the arbitration over other creditors. And if there is an equivalent mechanism in India, then it's worth looking at that, in terms of the types of options that lenders may have in order to ensure recovery.
Right. Let me move on then, and I'm going to get this answer from Marine, who of course is exclusively working with banks, and I'm going to get this answer today because I think our audience wants to know this. But just moving on from there, I want to hear more on diverted assets. Banks face that a lot, and today when we talk about defaults, there are a lot of fraudulent accounts where, especially in the infrastructure sector, overseas lendings or project guarantees given, banks realize that the large chunk of money has been siphoned off to other entities or to promoter controlled entities, and that's how the insolvency has come about. How does one use Omni Bridgeway in this scenario?
Right, that's a good question. So typically what happens is that you start from, when I say you, I mean the lender / potential claimant starts from a point of low visibility in cases like this, because the diversion usually happens under their nose, and maybe they don't have a controlling interest in the borrowing company or the debtor. So the starting point really is to conduct an investigation into what exactly went down. And that's part of our service offering, because we have internal asset tracing capability and business investigations capability. And once we work out internally whether or not there is an ability to recover, and you will also appreciate that it's not straightforward, because if someone is setting out to divert assets, divert funds, they're usually quite creative about it. And so we need to be equally creative in terms of coming up with solutions. So one challenge, for example, that we might face is your classic sort of trying to pierce the corporate veil, where a promoter of the company may have siphoned funds and then funneled it through a series of companies in order to avail himself of the separate legal entity doctrine in order to protect or shield himself from a recovery. And so we need to find a way to pierce that veil, and depending on the jurisdiction in question, that has various challenges or difficulties. So certain jurisdictions are more readily accept fraud exception, although the burden to prove that is fairly high. Some other jurisdictions, I believe India may be one of them, and Pratik, correct me if I'm wrong, go so far as to acknowledge a sort of single economic unit or entity kind of doctrine, which is absent from jurisdictions like the UK or Singapore. And that then gives us a different way of tackling the problem, because instead of trying to prove fraud, you can try and make another creative argument to say, well, you treat the entire corporate structure as one and the same, and then you are able to find a way to recover that. I think I also mentioned earlier, thinking out of the box. You try and go after the promoter's personal assets, or you try and touch assets belonging to folks who are near and dear to him. Again, those are not the most straightforward or easy to do, but we've done it before. And those are some of the kind of solutions that we've offered. When you're talking about sovereign entities now, that's a different ball game altogether. Why do I say that? That's because they can avail themselves of a sovereign immunity defense. So the threshold question there is, what is the asset and does it enjoy sovereign immunity? And again, depending on the jurisdiction that you go in, depending on what the asset is in which jurisdiction, the doctrine of sovereign immunity is applied differently. In some jurisdictions, like in the United Kingdom, it is a more narrow doctrine, and likewise in Singapore. Some other jurisdictions consider a much wider application of that doctrine, and what that means in practical terms for the audience is that the net over which is the asset pool is cast is wider as the doctrine is enlarged, because then the state can say, well, this is actually protected by sovereign immunity, so you can't touch that. So it's important to identify at the starting point. So starting from my answer again, where are the assets, where are they located, particularly what type of asset are they, and then you work out a multi-jurisdictional approach in order to achieve recovery. Because in our experience, at least in my experience looking at opportunities in India, a market which we are very excited about because of its huge potential, sometimes, in fact, oftentimes, when we consider opportunities brought to us by Indian infrastructure players, namely contractors, the one chief issue is recovery, because the recovery is largely domestic. And so, for example, if you're looking at an action against a PSU or an award that the contractor has brought, what a contractor has obtained against the PSU, what we then need to ask is, does the PFU have assets outside of India? Because then that makes the investment opportunity for us much more interesting, because the recovery there is better. Whereas if it was a purely domestic play, then I think some of the challenges that you alluded to in terms of the behavior of PSUs and state-linked entities and the state in India is to take it all the way up to the Supreme Court. That doesn't necessarily mean that we will automatically not consider these opportunities. It depends on the size of the deal and how much we are going to be putting in. But it does mean that the time horizon of our investment will change compared to a recovery that has international elements to it, where we find that when we can exert pressure on multiple fronts internationally, parties often decide to settle the dispute rather than to exhaust every avenue of legal appeal.
Those are pretty good points, Arvind. And as I mentioned in the opening of this segment, today when lenders look at assets, I think, as you rightly pointed out, there's lack of experience in a sense. I ask myself of why are we still pursuing purely local recoveries to investments which have a large structure overseas, or have played in the foreign markets, or have certain kinds of projects and receivable overseas. In our experience, the knowledge of cross-border insolvency, or where you can initiate liquidation proceedings and recovery proceedings, is the main lack. And I'm certain if the lenders use the right team and the right strategy and approach teams like yours, the innovative strategy of recovery, which you say would be available even in cases where it's hard to believe you can internationalize the recovery. And this is simply because India has internationalized significantly, and we are creating a lot of footprint overseas. And that's where I think liquidations, insolvencies using overseas platforms are something which lenders should look at. I'm sure your team has great experience in funding liquidations overseas. I'm not sure if you have done it in India, but could you quickly share with the audience of how we can think of you when we look at overseas insolvency and liquidations, or Indian insolvencies and liquidations?
Yeah, thanks for that question, Pratik. We do interact with resolution professionals in India in an insolvency or liquidation scenario. we approach the investment opportunity in a slightly different fashion. Usually, again, the resolution professionals aren't necessarily armed with the knowledge as to what the true state of affairs of the company is, or to put it more bluntly, they need an investment or they need some money in order to start their investigations. So at a high level, what we do is we can provide funding to the RPs to investigate and then see whether there are any claims that are worth pursuing. So the investment would be structured in such a way where the first bit might be to investigate the claims. And then at the end of phase one, which the investigations phase, which identifies potential avenues, for example, claims for breach of directors' duties, for fraudulent trading, for insolvent trading, or even looking at claims against third-party service providers such as auditors. And I'm looking at a very large opportunity surrounding an audit negligence claim, which is now on foot in the Singapore court. These are some of the avenues that are available, but before you get there, you need to undertake an investigation. So it's a bit of a balancing act, Pratik, because on the one hand, sinking in money to investigate the claim can be fairly considerable. So it's a balancing exercise. We like to work with resolution professionals who are prepared to, pick up the pen and do quite a bit of the initial groundwork and satisfy us that there's something there. And if we need further investigation, we're certainly prepared to put in some money in order to complete that phase before we move on to the second phase. So that's how we would structure something like that, and that's how we approach insolvency type claims or claims arising in an insolvent context rather. Now, of course, there can be a separate situation which is a bit easier, which is where the claims are already identified. And for example, when we work, almost always we work with lawyers on these sort of opportunities, such as yourself, and then you will be able to tell us, well, I think these are the claims that might arise in the nature that I've just described, right? Breach of fiduciary duties, etc., etc., etc. And then we work it up and we see whether or not it's worth pursuing and worth funding.
That's very interesting, and I think, Arvind, after your session today, a lot of lenders are going to think, if this tool was available to us, why haven't we used it till date? But I'm not going to let you go yet, because I have a last question for you before we close the session, and that's an interesting segment today. In the infrastructure segment, the main cash trap, as we heard, is the lenders are waiting for the infrastructure companies to pay, and the infrastructure companies are waiting for the government to pay. Or if you move to industries such as large airlines, you have airlines who've spent all the money to get certain aircrafts, and then you have the aircraft not being delivered, or faulty aircraft being delivered, leading to a lot of financial issues and crashes of the company. Now, in all these kind of situations, there are debtors debtor. And because the debtor can't recover from his debtor and doesn't have capital to recover from his debtor, the main creditor cannot recover from the debtor. Now, how does Omni Bridgeway approach the debtor's debtor conundrum, and can lenders look at you for help in this situation?
Yeah, I think that's the reason why we like working with you, Pratik, because that's a very innovative way of looking at it. It's the second category that I mentioned. If you look at directly at the debtor and you see how we can assist. So it's a really innovative way, I think, for lenders to look at recovering their debt by introducing litigation funding to their debtors to allow them to pursue their claims. So ultimately, it creates cash flow back to the debtor, which it can use to repay the lenders. And this has been discussed before, and it's consistent with our experience in the infrastructure sector in India when we're looking at opportunities, is that there are a huge number of contractors who are in stressed or distressed situations, but without the financial wherewithal to pursue good claims or indeed monetize arbitration awards, which they've gone through this extended process of several years, against various counterparties, but particularly against PSUs in India. So issue here is really for a lender the lender's stuck in a bit of a bind, right? I think the expression was used either by yourself or another panelist. You don't want to. I think it was you, Pratik. They don't want to throw good money after bad. So there's this reticence to extend further financing to allow these companies to pursue claims or enforce awards. And that's for a very simple reason, because traditional financial institutions don't have the expertise or the experience with how to go about doing this, and also how to put a value to these awards, because very often we find that when these opportunities are presented to us by Indian promoters, they come to us with very substantial awards worth thousands and millions of crores, but in fact, when you scrutinize the claims and awards, as you and I have done before when we've looked at some of these opportunities together, Pratik, the answer is that they need to be steeply discounted, because the award is not entirely inoculated from a challenge. So while at a broad level, it is true that the arbitration is meant to be final, we need to be sensitive to the way that India operates, and that the respondent will invariably mount a 34 challenge and bring it all the way up to the Supreme Court. And that's where one needs to look at the award as a starting point to see, okay, is it truly watertight, ironclad, or are there angles which it can be assailed? And can it be undercut in any way? And is there a chance that certain components of a damages award may be undermined or wholly dismissed by the supervisory court? Ordinarily, it shouldn't be the case, but we've recently encountered an example of a company which approached us with a very large value award. I'm not sure how much I can say about it, but almost every Indian lawyer I speak to has some working knowledge of this matter. And that award was set aside at first instance by the Bombay High Court. And then I think that's in the process of working its way through the legal process. But what's interesting there is that it just is an illustration of how things like that need to be scrutinized quite closely. And who knows, that company may prevail on the next rung of appeal. But these are some of the things which I think lenders need to be alive to, and really how you can partner with an organization like Omni Bridgeway, because we bring to the table two things to sum it all up. Number one is capital. And so the lenders don't need to put in more money. And the second is the expertise to really be able to assess the validity of these claims. And then, we can, if it's the right opportunity, we can put in our capital and realize a recovery that's beneficial for all three parties involved, the lenders, the debtor company, as well as Omni Bridgeway. So that, I think, is if there's any takeaway, I would encourage the members in the audience from lending institutions to see how you can assist your debtors by introducing litigation funding as a concept. I'm happy to take further questions from the audience or from Pratik, from you, in terms of some of the finer points as to what our returns might look like and so on and so forth, or happy to take that offline, whichever way, but maybe I'll stop there.
Thanks so much, Arvind, and you make a very valid point, especially with regards to the appeals and awards. But I do want to share some experience there, especially with the lenders and the other members here. Wherever there is a challenge, there is an opportunity. And today we've seen that India has started giving almost 50-75% deposits in awards when they are in appeal. And we've seen litigation finance structures being discussed where today, if the award is watertight and there is no chance of, or there is not significant chance of the award being set aside at the later stage, litigation financiers leverage their own book to even give bank guarantees to release the sums, which creates cash flow for the lenders immediately. So effectively shifting the risk of judgment overturned to their book. And we've seen insurance products being released to cover that risk of an eventual overturn. So I think it's very interesting times ahead. If lenders today are open to innovation, I think good recovery at no cost is a real possibility in the Indian market. With this, I am done with the session on my behalf and the audience. But I would ask my co-panelists to raise any questions if they have for Arvind, and if not, I can end this session and hand over to the host for the next session.